Welcome to today's Daily Brief Explainer. Look, if you've been reading the financial headlines lately, you might feel like you need to run and take cover. Seriously, we're seeing this massive wave of fear just dominating the financial press right now. Everywhere you look, it's all warnings of an impending crash, massive sell-offs, and total doom and gloom on the horizon. But, here's the thing about fear in the financial markets. It often masks incredible opportunity, if you know how to look at the raw data. So today, we're going to cut right through the noise, ignore the panic, and look exactly at what the numbers are actually telling us. Okay, let's dive right into it with this. Artificial intelligence is a bubble, and it is about to burst. This quote perfectly captures the prevailing narrative being pushed by some of the absolute biggest, most respected institutional voices in the market right now. We're hearing from legendary fund managers and major banks who are practically shouting from the rooftops that the AI craze has gone way too far, that valuations are just absurd, and that the bubble is on the absolute brink of popping. Basically, they want us to believe the sky is falling.
And the thing is, they aren't just talking, they're acting on it. Institutional managers have been aggressively selling off tech stocks at historic rates. You've got high-profile investors opening massive short positions on major names. We're talking Tesla, Nvidia, even heavy industry stuff like Caterpillar. Across the board, these fund managers are drastically reducing their overall exposure to U.S. equities. You even have major players stepping out and forecasting this complex three-wave correction. They're all in agreement, and they are positioning themselves hyper-defensively.
Now, when everybody in the institutional world agrees on a catastrophic outcome, we have to pause for a second. We really need to ask ourselves this fundamental question. Are these defensive maneuvers and all these panic-inducing headlines actually justified by the underlying market mechanics and the macroeconomic data? Or is there a totally different story playing out just beneath the surface?
What's absolutely fascinating here is the stark contrast in behavior. On one side, we have the so-called smart money, the institutional managers, selling off and running for the hills. But on the other side, we've got retail investors actively buying into these dips and doing something completely extraordinary. And historically, extreme institutional selling like this can actually serve as a magnificent contrarian indicator. When the pros reduce their exposure this drastically, it often signals that the market is just shaking out the weak hands right before launching into a massive upward wave.
And here is the fuel for that potential upward wave. $5 trillion. That's a 5 with 12 zeros, folks. That is the unprecedented amount of capital that retail investors and households are currently sitting on in money market funds. It is literally the highest figure in history. So why does this matter? Because this is pure dry powder. If the stock market continues to show resilience and pushes higher, this massive mountain of cash is going to start flowing directly into the system, driving prices up even further as people rush back in so they don't miss out.
So if we're ignoring the fear-mongering for a minute, what should we actually be paying attention to? Well, let's look at the real driver here, which is liquidity. Forget all the noise, we need to follow the money.
To really understand where we are right now, we have to look at where we started. Think back to the year 2020. Right around the time the global economy was facing those unprecedented shutdowns, the M2 money supply in the U.S., which is essentially all the cash and easily accessible money in the entire economy, sat at roughly $15 trillion. Keep that baseline in your head because what happens next is truly staggering.
Today, that number has skyrocketed to an incredible $23 trillion. We're talking about an increase of over 50% in just a few short years. The sheer volume of money just sloshing around the global financial system right now is absolutely monumental. You really can't analyze stock prices or market health without adjusting your calculations for this massive, massive influx of fiat currency.
To put this into a bit of historic context, let's look at the M2 levels during the 2008 financial crisis. People love to compare today's market to the 2008 crash, right? But when you look at the actual liquidity in the system, it has practically doubled since that time, and then some. The financial plumbing of the economy is just completely overflowing with capital.
And get this, the growth isn't even stopping. The M2 money supply is currently growing at an annual rate of over 6%. Actually, this past May, it experienced the largest single-month increase in history. So the absolute crucial point is this. Until central banks start aggressively and meaningfully draining this liquidity from the system, the most mathematically probable scenario is that the bullish trend in equities is going to continue. As they say, liquidity lifts all boats.
Which naturally brings us to our next major point, the market concentration myth. This is another absolute favorite narrative of the doom and gloom crowd. You probably heard the idea that this entire market rally is just a house of cards, right? Propped up by a tiny handful of massive tech companies. Well, let's go ahead and debunk that right now. The data completely contradicts the narrative that only 5 or 6 stocks are going up. Just look at the Russell 2000, which tracks small-cap stocks. It's been hitting all-time highs. The MDY ETF, which tracks 400 mid-cap companies, is also breaking out to all-time highs. And the Dow Jones Industrial Average is sitting right at or near historic peaks. Market breadth is actually incredibly strong right now. Small, medium, and large companies are all participating in this rally. So that fear narrative, it's demonstrably false.
Now, let's zoom in on the specific sector that literally everyone has been talking about: semiconductors. This is the exact area that institutions have allegedly been dumping.
But when we look at the raw technical chart for the semiconductor index, we are definitely not seeing a bursting bubble. We see a clear, undeniable uptrend. Recently, the index pulled back a bit and hit its very first line of support around the 572 level. And what happened? It didn't break down. It bounced aggressively, with real ferocity. This kind of price action is the hallmark of a deeply entrenched, healthy bull market, not some fragile bubble just waiting to pop.
And there's a rock-solid fundamental reason for this technical strength. The demand for semiconductors isn't just a speculative mania. It's rooted in massive, real-world infrastructure investment. We are seeing relentless demand for AI processor manufacturing. The construction of enormous data centers is accelerating globally, and the requirements for advanced optical memory are expanding exponentially. These aren't fads. These are structural, multi-year economic shifts driving real, tangible revenue.
So as investors, our job really isn't to sit around and worry about whether a handful of stocks have too much weight in the broader market. Our job is to go where the strength is. And right now, undeniable relative strength lies in semiconductors, cybersecurity, and optical memory. When they experience a technical shakeout or a dip, they get bought up almost immediately. That is exactly where a smart market participant wants to be positioned.
So let's talk strategy. In an environment like this, dominated by terrifying headlines but supported by immense underlying liquidity and strong technicals, how should we actually operate?
We need to become what we call the disciplined speculator. Now, the defining trait of this approach is actually the acceptance of failure. Sounds weird, right? But a disciplined speculator knows they are going to take losses. In fact, they are experienced losers. But the secret sauce is that they keep those losses strictly controlled and minimal on any weak positions. They do this so they can stay in the game and aggressively maximize their gains by riding the momentum of those highly resilient sectors we just talked about.
And that leaves us with one final thought to really chew on today. The headlines, the institutional rhetoric, and all those market pundits, they're giving you a masterclass in fear. But the charts, the broad market participation, and that $23 trillion in the money supply, they're giving you a masterclass in liquidity. The data is clear, the trends are intact, and the cash is just waiting on the sidelines. So going forward, how are you going to manage your portfolio? Will you follow the fear, or will you follow the liquidity? Thanks for joining me on today's Daily Brief Explainer, and I'll catch you next time.